Right now, the world owes more money than it has ever owed in human history. Over $100 trillion, close to 95% of everything every economy on Earth produces in a year. The World Bank has a name for it: a silent debt crisis. It isn't just a headline for finance ministers. When a government drowns in debt, hospitals stop getting built, currencies lose value overnight, and your own savings can quietly shrink even if you've never borrowed a cent in your life. In this video, you'll see exactly how this trap works through 4 real countries living inside it right now. And the biggest twist isn't what most people assume. The country blamed most often for trapping poor nations in debt is, in the most famous case of all, barely even involved. The real trap was built somewhere else entirely. Stick with this one till the end, because that story alone rewrites what you think you know about global debt. The trap explained. Here's the real problem. Debt itself isn't dangerous. Governments and households borrow constantly, and usually that's fine. What's dangerous is one brutal rule. If the interest rate a country pays is higher than its economic growth rate, the debt ratio climbs on its own, year after year, with nobody making a new mistake. The only way out is a government surplus so painful it can topple leaders. Rich nations rarely fall into this. Germany borrows at around 1.5% to 2% interest. Poor and developing nations pay closer to 11% because markets see them as risky. That gap alone is why the poorest countries on Earth have watched their interest payments quadruple in a decade, now swallowing about 6% of everything they export, pulling money away from schools and hospitals to cover interest. It gets worse because of how modern debt is structured. Decades ago, poor countries mostly borrowed from a small, visible club of government lenders. Today, their creditors are scattered. Commercial bondholders, private funds, and hidden loans issued through state companies, some locked behind confidentiality clauses that block even the IMF from seeing the real terms. And because these countries don't have currencies the world trusts, they borrow in dollars. When their currency weakens, that dollar debt instantly gets more expensive to repay. A trap economists call original sin. 4 countries show exactly how this plays out in 4 different ways. Argentina. The serial defaulter. Start with Argentina, the world's most repeated defaulter. Since independence in 1816, it has defaulted 9 times and entered 21 separate IMF bailout programs. In 2001, it defaulted on over $100 billion, the largest sovereign default in history at the time. In 2005, President Kirchner forced private bondholders to accept a 70% loss on what they were owed, then paid the IMF back in full. A small group of holdout investors, including hedge fund manager Paul Singer, refused that deal and sued in U.S. courts for full repayment. In 2012, one of these funds actually seized an Argentine Navy training ship docked in Ghana, holding it hostage for 2 months until an international tribunal ordered its release. In 2018, Argentina took a record $57 billion IMF bailout, the largest in the fund's history, approved without the congressional review its own constitution required. It failed. Argentina defaulted again in 2020. Today, under President Milei, Argentina is the IMF's single largest borrower on Earth. About $65 billion, 4 times what war-torn Ukraine owes. It has already paid $12.5 billion in interest alone, without paying down what it originally borrowed by a single dollar. South Korea. When the trap is personal. Now flip from government debt to personal debt, because South Korea shows this trap works on households too. By 2021, South Korean household debt was the highest in Asia, and the average household owed roughly $65,000, more than a full year's income, even if every one earned went straight to debt. It started after the 1997 Asian financial crisis, when the government pushed citizens toward consumer credit to revive the economy. The average Korean now carries close to 4 credit cards, and that debt poured into real estate speculation, encouraged by politicians who avoided painful fixes to protect their own time in office. The consequences are still unfolding. By early 2026, over a quarter of Korean households were spending more than they earned, rising to over 60% among the poorest fifth, whose interest costs jumped 26% in a single year while their income barely moved. By a broader measure that counts discouraged and underemployed young people, not the narrow official rate, joblessness among young Koreans has run near 27% in recent years. The personal bankruptcy carries lasting social stigma, and economists now link this debt directly to South Korea's collapsing birth rate. Zambia. The debt nobody could see. Zambia shows what happens when debt hides. After its old debt was forgiven in 2005, Zambia borrowed over $10 billion from Chinese lenders through 2020, pushing its debt-to-GDP ratio to nearly 104%. In November 2020, it missed a $42.5 million bond payment, becoming Africa's first pandemic-era sovereign default. But the real scandal was transparency. Zambia officially reported $3.3 billion owed to China. Independent researchers found the real figure was closer to $6.6 billion, nearly double hidden inside unreported state-backed loans, including a $1.5 billion hydropower loan the government never disclosed. Restructuring dragged on for 3.5 years before China and France finally agreed to co-chair Zambia's creditor committee in 2023, unlocking aid that let the government hire thousands of new healthcare workers. Sri Lanka. The myth that isn't true. And now, the twist. The most repeated debt trap story in the world is Sri Lanka's Hambantota port, the claim that China lured Sri Lanka into unpayable loans just to seize the port. The evidence tells a different story. In 2017, Sri Lanka leased 85% of the port to a Chinese company for 99 years for $1.12 billion, and that money didn't go toward the port's construction debt at all. It went to pay down other far more expensive debt owed to Western bondholders. Chinese loans made up only 10% of Sri Lanka's total external debt. The Hambantota loans were just 4.8%. The real driver was international bonds sold to global investors during the cheap money era after 2008, which turned crushing once the U.S. Federal Reserve raised rates in 2013. By 2021, those bonds alone made up 35% of Sri Lanka's foreign debt. In April 2022, Sri Lanka defaulted completely. Inflation surged past 70%, the country ran 15-hour power cuts, and mass protests forced President Rajapaksa to resign that July. One rare success came out of the wreckage: a digital QR code fuel rationing system that cut the country's monthly fuel import bill from $500 million to $240 million. 4 countries, 4 different traps, but the same lesson. What sinks a nation isn't how much it owes. It's who it owes, what currency that debt is in, and how visible it is. Fixing that doesn't come down to individual willpower. It needs cheaper, fairer financing for poor nations, and a genuinely neutral referee to manage defaults, because right now the IMF and World Bank are both lenders and judges in the same case. A conflict of interest built into the system itself. This isn't an abstract financial story. It's hospitals that don't get built, currencies that quietly steal your savings, and, in South Korea's case, entire generations deciding they can't afford to start a family. Debt traps rarely look dramatic while they're forming. They look like ordinary decisions, made one budget at a time, until the interest bill outgrows the ability to pay it down. If this video helped you understand how global debt traps work, subscribe to the channel for more deep dives into the financial systems shaping economies and the people living inside them.